This is a great strategy for trading shitty sideways markets. What are we talking about? We're talking about gamma scalping today. It's a sophisticated trading strategy which is used primarily by option traders to manage their portfolio risk and profitability. It basically involves adjusting your portfolio dynamically adjusting your portfolio's delta while benefiting from the changes in the underlying assets, price movements and price volatility. Now, it's a great strategy for trading sideways markets, and it's rarely considered by retail traders and usually considered by professional traders. However, what we can do with this strategy is set it up with the intention of scalping the gamma or gamma scalping, rather than using it to adjust portfolio risk, which is, again, predominantly what the professional traders do. So let's explore that today. Ahoy there, trader, it's Phil, and welcome to the Anti-Investor Stocks and Options Trading Podcast, where we talk about what really works and consistently wins at trading financial markets. My goal is to give you the right tools, the correct rules, the software to assist you, a community to support you, and if you'll allow me to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. Right then, so in my fast forward trading mentorship group earlier this week, as I'm recording it, we're doing this in the middle to end of June. We explored one of the many and varied ways that we can trade the markets using options. And what I'm aiming to do usually is to have strategy diversification. I don't necessarily look for market diversification in the traditional way that stock and bonds split, but I do look for diversification with strategies. And gamma scalping is one of my favorite strategies. And again, it's rarely discussed by retail traders, but it is often used by the professional traders in their toolbox of things to do. Now, there's three ways that I use the principles of gamma scalping, because again, it depends on the trader as to how you use them, but there's three primary ways that you can look at scalping or gamma scalping. The first one, the obvious one, is hedging. You protect your portfolio against adverse market movements. The second one, which is similar, is profit locking by securing gains and adjusting the positions based on the delta. We'll be exploring that one in a bit more detail in a moment. And the last one is risk mitigation, which reduces the potential losses again by flattening the delta. Now, the last one, the risk mitigation, let's put this into context. Hedging, if you think there's going to be a weird movement, you might hedge your position, flatten the delta without interfering with your core position. Profit locking, we'll explore that later. We're looking to set the trade up so we can intentionally scalp the fluctuations in the market movements. And again, I'm using the word scalp, but it's actually swing trading. You're holding trades overnight, so you've got plenty of time to do this. You're not sat at the desk. So there's again, you can do this without being at the desk for hours at a day. You can do it at the end of the day. You're scalping the gamma, not scalping pennies out the market. You ideally looking for dollar movements or more. Anyway, the last one, risk mitigation. Think about that like a stop loss. Again, you're doing exactly the same thing. You're flattening your delta, but your position remains open. So that you can potentially turn a losing trade into a winning trade from a dollar point of view. Now then, we do need to understand some things before we explore this strategy. We need to understand delta. We could dive deep on the option side of things, but just as an introduction, just as a primer, let's just look at the one thing, delta. So an option contract controls 100 shares of an underlying stock, and the option's value fluctuates with stock price, and it's measured by something called delta. And again, you have a proportional value assigned to the stock. So for example, if you have 100 stock, you have an at-the-money option. The at-the-money option may be worth, for example, 50 delta. And that's the number that we're interested in. Again, you don't get the whole value of the option contract unless it's in the money at expiration. In that case, the delta would be 100. So even if the option contract is 1 penny past the strike price in your favor, the option gets assigned a value of 100 delta because you're going to be issued the stock. So between now and expiration, and depending on where the stock price is and how deep we are in the money or out the money, you get this fluctuating delta price. Now, if the option expires worthless at expiration, so it's out of the money, you're not going to be issued the stock. It's cheaper to go to the market and just buy the shares. So the option contract would be assigned a value of 0, and it's not worth anything. So it would have a 0 delta because it's out the money or it's worthless. Now, so when we know that, we can start to potentially take advantage of these fluctuations. So a quick example might be best at this point. So PayPal is a stock that I was looking at. PayPal has been sideways for many, many months as I'm recording this. And we set up a long straddle. So a straddle is essentially the simultaneous purchase of both a call and a put at the same strike. In this case, I chose $65. And what I'm expecting is for the stock to continue to go up and down, up and down, up and down between this upper and lower boundary of range that it's been developing over the last 1 to 2 years. So as the stock moves, the value, let's be fair, in this case, the stock has moved down by $5. So we've gone from 65 down to 60. Now, as a result of that, the long put has increased in value. It's gone from being worth minus 50 delta because it's I will be assigned short stock at expiration if I took it to that expiration. So I'm at the time of the trade, I've effectively gone short the equivalent of 50 shares. So I'm profiting on the way down from 65 to $60, and the delta increases the further that the put goes in the money. So by the time we get to $60, that option has the equivalent profits of 75 shares or 75 delta. We can use that word share and delta interchangeably. So what I can now do is I can flatten the delta and lock in the profit. So I'm effectively, with a put, short the $5 stock movement, and that would be the same as saying I went short. The profit is the equivalent as if I was short 75 shares. So I can lock that profit in, and I can buy 75 delta or 75 shares. Now the goal then is in a perfect world, what I want to happen is for the stock to go back to $65, and then I would close that stock portion. So what would happen is the put profits on the way down from 65 to 60. I've got a profit that's the equivalent of being short 75 shares without having the shares, which is great. And then I'm going to transfer the profit, or I'm going to lock the profit in by going long 75 shares. And then what's going to happen is as the stock rallies, the option loses that profit, but the stock will gain the profits. So I'm transferring the profit from the option into the stock. Again, should we get back to where I initiated the trade at around $65, I will close the stock position. So I'm then transferring the profit from the stock into my account. So it's not open profit anymore, it's locked in profits. So now I'm reducing my cost basis for what it cost me to buy the put and the call in the first place. And what ultimately I want to do is I want to be able to do this several times. Now, I don't want to hold the options until expiration. I want to essentially profit 2 or 3 times as the stock goes up and down, up and down. And if I can do that 2 or 3 times in the next couple of weeks, that'd be great. I've got plenty of time on the option, so I don't really have to worry huge amounts by fast option decay. I'll still have it, the theta, but because I've got this long dated option, I want to use about 30 to 50 days in a perfect world. I want to see the stock price go up and down. And if you look at the PayPal chart at this time, again, we're in the middle of June in 2024. If you listen to this in the future, hello. And you can go back and you'll see the stock, it's oscillating back and forth, back and forth, back and forth. So I'm aiming to scalp the gamma, to do this profit locking exercise multiple times over several days, so that I've got a profit net overall, then I can close that option position. I've got the profit in the stock, and it's a nice way to profit from, again, sideways market conditions. So some different approaches that I can take with this. Now, I don't have to buy an at the money straddle. What I can do is I can have a directional view with this. So I can place a call or a put And that will reduce my initial capital requirements as well. It's not hugely capital intensive with the option side, but obviously there is some with stock. But I can do this with just a call or just a put. So I can have a directional view. So if you're at a very clear consolidation and you're at the range low, and you would have a bullish viewpoint because you're at a range low, you think that the stock's going to continue to go from the range low to the range high, you can buy a call when we get to the range high. If there's no obvious breakout move, you can flatten your delta and profit from a downward movement in the stock. And again, you can do that multiple times. Or when you get to the upper boundary, you can buy the put and flatten the delta. So you've essentially managed a long straddle that would effectively in the money. So you're looking for price to bobble back and forth between the two options, and you can lock the stock in on the way up and the way down, lock the profit in on the way up and the way down. So you can have a directional viewpoint should you choose to, and leg into this type of strategy. And again, directional viewpoints, we've spoken more about the profit locking, so secure profits by adjusting the position based on the market's movements. We want to be able to do that several times. And we can also use it to hedge. So if you've got a directional viewpoint, maybe you've got long calls for a swing trade and you think, hey, maybe there's going to be a market retracement. And rather than close your position, what you can do is, again, hedge the position. You can flatten your position or a portion of that position with this profit locking exercise and flatten either part or all of the delta, so that if there is that retracement or an uncertain news event that just makes you pause for thought, I don't want to sit through that retracement and see those profits go, you can lock in that profits with the delta flattening exercise that we've just gone. And if there is that retracement, after the event or after the retracement is over, again, you can cash out, so without interfering with that core position. And the last one that we've mentioned is risk mitigation. I explained that earlier. Is think of that like a stop loss. The trade's not working out in the right way, you can effectively lock in a loss is what you're doing, but you're not going to lose any more. So if there's a continued unfavorable movement, because you're short the delta in the form of stock, the option's going to reduce in delta the further out the money it goes, but you'll still be short the same number of shares. So you can end up with a profitable trade, thus mitigating the risk of a trade that's just not worked out. So it's a good management tool when used correctly. So again, all of these things, when done correctly, gamma scalping can add to your trading toolbox in directional noisy, crappy, shitty market conditions. So again, it's a great strategy just to add into your toolbox. And again, I go through this along with several other strategies in my fast forward group training. And so again, we can follow PayPal. We've got this live one on at the moment. Currently, the put side of the trade is working quite nicely, and it's right at a great support level where we're expecting a bounce back or a move higher, ideally back to $65 or better for that matter. You can go the opposite direction. So again, we've got a live one on the go for a change. So that's where we're at for the moment. Gamma scalping in a nutshell. We aim to profit from the way the options are priced and the fluctuations in shitty, sideways, crappy market conditions. We're looking at this from a swing trade perspective. It is a fractal strategy, meaning that you can apply this on shorter time horizons with less dated options. Again, you don't have to use a high value stock. You can use a low value stock like Ford if you want to kind of wet your whistle with a few option contracts and a few shares, so it doesn't break the bank, so you can kind of understand the mechanics of it with a live trade. So again, there's plenty of scope for scale with this type of strategy, and not worry at all about what the market's direction is overall. So that's it. Gamma scalping, hedging, profit locking, risk mitigation, and setting the trade up with the intention of gamma scalping in our PayPal strategy with a long straddle. So that's all for now. Thank you very much for your time and attention. If you like your head today, be sure to follow and listen to the very first episode where I map out one of my several money-making strategies. And if you go back just a few episodes, you'll find my 2024 strategy with SPX options. And if you'd like to learn more about my mentorships and training, head over to antivestor.com or shoot me an email to phil@antivestor.com and let's start that conversation. I've always got a lot of time for serious traders, and if you like what I've heard, maybe you want to take the next step. And if not, I'll always point you off in the right direction for what you're looking for. So that's it for now. I'll see you at the same time next time. Toodaloo trader, bye for now. Keep in mind that futures, options on futures, stocks and stock option trading involve a degree of risk that may not be suitable for all investors. There is a risk of loss in every investment that you make, and it's your responsibility to assess the risks of your decisions. Past performance is no guarantee of future performance, and Anti-Investor provides educational information and does not provide financial advice.